Hello everyone, I'm Suneel Maheshwari, Professor of Accounting at Indiana University of Pennsylvania. Thanks for joining me today. We'll be talking in general about the topic of income, accounting for income taxes. Within the taxes, we'll be talking about two topics, which is deferred tax assets and liabilities. So when we talk about these topics, this is what we are going to do. We'll talk about why there are differences between the taxable income and accounting income, what are the temporary differences and permanent differences, and what are deferred taxes and liabilities. Once we have covered the definition of deferred taxes, tax assets, and tax liability, we'll get into one or two examples for each to wrap up the session. So, generally speaking, there is a difference between the revenues and expenses reported under the tax purpose and also revenues and expenses reported under the accounting income. Why are those differences? So why is this taxable income different from the accounting income? One of the reasons, the primary reasons, is that the objective of the financial reporting is not the same as for the Internal Revenue Services. The tax law was made by Congress to raise funds in a socially acceptable manner and influence the behavior of the taxpayers. The FASB provides the information to investors through the financial statements. So the purpose is different, and therefore sometimes the differences might arise between the taxable income under accounting and the tax and for the tax purposes. Now, when do they? How do the differences arise? The differences arise because you might be recognizing an accounting income for tax purposes, but not for the accounting purposes, or you might be deducting certain expenses under tax purposes, but it is not allowed at that time for the tax purposes. So there might be differences that might arise, and these differences will arise in one period, and if these differences, the difference between the two returns, reverses in the next period, then those differences are called temporary differences. Now, for example, if you sell a property on an installment basis, it is, for the financial reporting purposes, it is reported in the year of sale. But as far as taxes are concerned, you will report it as income when it is actually received. So in this case, the accounting income will be higher in the year of sale, but the tax income will be higher in the subsequent years when the money is actually received. Permanent differences are those differences which do not reverse themselves. Now, for example, you have invested in municipal bonds which are tax-free. So if the income is tax-free, it will never be reported on the tax returns, but it is reported on the accounting return. This brings us to the definition of deferred tax assets and deferred tax liabilities. In terms of deferred tax liabilities, when an amount increases the taxable income in the future period, the company reports a deferred tax liability. So this is an amount or a liability which has to be paid or which increases your liability in the future. So that's a deferred tax liability. In case of deferred tax asset, it's the opposite. So when an amount that reduces the taxable income in the future, or one of the differences that reduces the income in the future, it is reported as a deferred tax asset. While making the journal entry, the tax expense will work like a plug figure. Let's take an example for a deferred tax liability. You've got Kent Land Management that reported a pre-tax income of in 2016, 17, and 18 of $100 million, plus an additional 2016 income of $40 million from installment sale of property. So in this case, 2016 will have a income of $140 million. 2017 and 18 will have an income of $100 million. However, the installment sale is collected as follows. In 2017, 10 million is collected, and in 2018, 30 million is collected, and the tax rate is 40%. So as far as the accounting income is concerned, you have got 140 million in 2016, which is basically 100 million plus 40 million from the installment sales. In 2017 and 2018, $100 million is recorded. Now, as far as the tax adjustment is concerned, since the tax law do not allow that income to be recognized unless and until it is received in 2017 and 18, so to come to the taxable income, we reduce that by $40 million. That basically gets the taxable income to $100 million for 2016. So as far as the accounting income is concerned, it is $140 million, but the taxable income is $100 million. In the next year, when $10 million is collected in 2017, the taxable income increases by the $10 million and by $30 million in 2018. Over 3-year period, the taxable income is same and for over the 3-year period, $340 million. So the taxes which you will be paying, or the company, land management, Kent Land Management will be paying, is basically same under each one of them. However, in 2016, that $40 million tax on $40 million will be deferred to the next 2 periods. So in this case, the total tax payable currently will be $40 million on a taxable income of $100 million. Now, on that $40 million, at the rate of 40%, and you have got a $16 million of deferred tax liability, which is going to be created. Now, when you say this will increase, basically, why is it a deferred tax liability? Because it will increase the tax liability in the future period. So you have started with a balance of $16 million. If you look at the T account of the deferred tax liability, you have got a $16 million of balance over there. So the income taxes payable credited for $40 million, deferred tax liability of $16 million, and therefore the income tax expense is your $56 million debited. So in this case, there is an income that is going to be recognized in the future, so the liability of taxes payment on $10 million and $30 million is transferred in the future. So on the $10 million at 40%, you'll be paying $4 million, and on $30 million, you'll be paying about $12 million later on. So coming to 2017, you've got that deferred tax liability is reduced by $4 million on that $10 million deferred income, and your income tax payable becomes $44 million, $40 million on $100 million of income plus $4 million on the $10 million worth of income. So your balancing number of income tax expense is $40 million. In 2018, if you look, similar thing will happen. Instead of 10 million, now you have got 30 million. Your tax on 30 million is the deferred tax liability, which will reduce as by $12 million. So deferred tax liability is there for $12 million is debited, and income taxes payable is 52 because 140 on 100 million and remaining 12 on $30 million. So the income tax expense for 2018 will be reported at $40 million. So this is how the journal entries will look like, and if you look at the deferred tax liability at the end of year 3 or at the end of 2018, your deferred tax liability becomes zero. All the temporary differences basically has been reversed over a 3-year period. When you look at the deferred tax liability balance, it started with opening balance was zero. Your 16 million was recorded in 2016, and then it reversed 4 million and 12 million in 2018, and therefore the temporary difference was reversed in 2018. As far as the deferred tax assets are concerned, they are recognized for the future tax benefits of temporary differences that create future deductible amounts, or basically it reduces the future taxable amount. For example, if you recognize more future expenses for tax purposes or less future revenue for the tax purposes, in that case your deferred tax asset will be created. Let's take an example for deferred tax asset. You have got a RDP networking. They reported the following income in 3 years, 2016, 17, and 18, at $70, $100, and $100 million. The 2016 income includes a $30 million warranty expense that is deducted for the tax purposes when paid in 2017, and 15 million in 2017 and 15 million in 2018. The income tax rate is 40% each year. So in this case, you've got a pre-tax income of $70 million, but the taxable income is increased by $30 million because that expense will be recognized later on for the tax purposes. So to come to the taxable income, we have added back the $30 million to come to $100 million. So accounting income is $70 million, taxable income is $100 million. Now, in the future period, since we are recording the $15 million expenses actually incurred in 2017 and 18, the taxable income is now reduced by 15 million, and for each of the 2 years, your taxable income now is 85 million. Over the 3-year period, you have got the total taxable income at 270 million. So the difference was created in 2016 and reversed in 2017 and 2018. So on $100 million, you will be having a tax of $40 million. In addition, on the $30 million, which we have backed out, or which will be written off in a future year, it's a future deductible amount, you have got a 40% on that $30 million at $12 million, a deferred tax asset of $12 million is debited, which is created. Income tax payable is $40 million, and the balance of the number is the income tax expense. So this $12 million will reverse over the next 2 years as follows. In 2017, you're on $15 million, you've got a reversal of $6 million of deferred tax asset. So deferred tax asset is now credited by $6 million. Income taxes payable is $34 million because it has gone down by 6, and your income tax expense is $40 million. Similarly, in 2018, a reversal will take place of the remaining $6 million. Very similar entry as in 2017, and your income tax expense at $40 million. So in this case, deferred tax asset was created at $12 million. It is now reversed over 2-year period, that is in 2017 and 18. Deferred tax asset has been realized, and your balance is zero at the end of 3 years. Thank you very much for listening to this presentation. Have a nice day.